Hello and welcome to The Bottom Line here on TVP World. This is where we unpack the main business and economic stories of the day. I'm your host, Marie Cato. The Polish Monetary Policy Council cut the key interest rate on Wednesday afternoon by 25 basis points to 5%. The decision was prompted by a lower than previously forecast level of inflation in Poland and was expected by economists, albeit later during the year. Jakub Kapiszewski has more.
In an unusually tranquil world of macroeconomics, Wednesday's cut was quite unexpected, as evidenced by the reactions from research bureaus of major Polish banks. Economists at PKO BP, the biggest Polish lender, tweeted that the decision surprised them and the market consensus. Those from PKO wrote the decision of the MPC came as a surprise. ING, the fourth biggest bank, wrote, "The MPC startled us with a 25 basis point cut." However, it was the timing of the cut, not the cut itself, which surprised economists. During his last press conference, Adam Glapiński, the governor of the Polish Central Bank, was reluctant to commit to further cuts after the MPC lowered rates by 50 basis points in May.
Let me repeat, adjustment doesn't automatically start a series of cuts. I'm not ruling it out, and I'm not saying it's going to happen, especially given all the factors that may push inflation up in the coming quarters.
Why the change of mind? It all boils down to the central bank's new inflation forecast, which guides the Monetary Policy Council's thinking. A fresh projection from July shows significantly lower average inflation for 2025, down from 4.9% as the bank's forecasters predicted in March to 4%. Even after the cut, the key interest rate in Poland is higher than the one in the Eurozone or the Czech Republic, albeit lower than in Hungary or Romania, with both countries at 6.5%.
And now another story today. The Romanian government is under fire after announcing severe austerity measures designed to slash the budget deficit currently running at 9%, the highest level in the European Union. The Prime Minister says austerity is necessary to avoid Romania becoming a pariah for finance markets. But the question is, how far can it go without derailing the economy? Jan Kendi has the latest in his report.
Dozens of Romanian state employees gathered outside the Court of Appeal in Bucharest, protesting salary cuts proposed by the government as part of its new fiscal plan.
We have a single surplus cut to 12% from our salary, and without it, public workers' wages are only 1,100 euros.
The austerity measures come as Romania's public deficit surged past 9% in 2024, 3 times the EU's suggested limit. And the newly appointed Prime Minister, Ilie Bolojan, warned about the dire consequences of not taking swift action.
The Romanian state could become insolvent, which would mean that our creditors, those who lend us money at present and whom we need in the future because we cannot function otherwise, would no longer lend us anything, and therefore we would not be able to cover state expenses, including salaries and pensions.
The consolidation package, aiming to push the deficit below 6%, is set to come in 2 rounds, the first taking effect on August 1st. It will include a VAT reform, a 10% excise tax increase, an expansion of the healthcare contributor base, and the introduction of a new pension tax threshold. Starting next year, the government plans to increase taxes on dividends, gambling winnings, and bank profits, and introduce caps on public sector salaries and pensions, as well as increase teaching hours and cut student scholarships. But this is just the beginning, with more measures set to be announced within the next few weeks. A crucial step towards securing much-needed EU funds.
Our economy is doing badly. It's not a catastrophe at this point. We have billions and billions of euros from the European Commission that are blocked because we are incapable of, doing some reforms like special pensions and stuff like that. With the new government right now, we have until October. The European Commission gave us time to address the situation in Romania.
Credit rating agency Fitch currently rates Romania at BBB-, 1 notch above junk status with a stable outlook. But with the next review approaching later this year, the pressure is on the government to deliver and maintain investor confidence.
Obviously, there is a lot going on in the region economically, keeping us on our toes. So without further ado, let's bring in Professor Witold Orłowski, an economist and lecturer from Warsaw's Vistula University, to unpack the details. Hello, and thank you very much for joining us. And I wanted to begin our conversation with what is the likelihood that we might see another interest rate cut before the end of this year, and what might it be dependent on, how high can it be, and what impact might it have on the Polish economy?
Well, there is some chance for the further cuts, not big ones, but still. But everything depends on a few factors that are unknown. Actually, it's already visible in the current decision. That first, we did have the fall of the oil price, imported oil prices over the last year by 10%, until pretty recently, right? Until something has happened in the Middle East. So this process of falling price of fuels may be finished or not. We will see. I mean, still it is unclear, and probably on the one hand, the Policy Council was nicely surprised by the fact that inflation went down to some 4% in June. But on the other hand, we know that there is a risk with the growing energy prices. We know that there is a risk with the wage growth that once again accelerated a bit over 8%. And there is the issue of the frozen energy prices. So altogether, the central bank, the Policy Monetary Policy Council, has got a good reason to say, okay, the inflation that we observe today, that we have been observing over the last few months, was on a decent level, 4%. It really means that it is under control. It is above the target, obviously, but it is under control. So there may be some place to cut the rates, meanwhile,
Okay.
25 basis.
I wanted to ask
on the
about...
other hand, still, what will happen in the future, they will have to see. And as President Glapiński said, I mean, they will, with the new decisions, they will have to observe what will be happening.
Absolutely. I wanted to talk a little bit about Adam Glapiński, the central bank's governor, and about the way he actually communicates and delivers this information. Yet again, at today's press conference, he declined to comment and to commit to an interest rate path. So no information, no sort of forward guidance, which is actually quite standard when it comes to the way central bank governors actually communicate at these sort of events. What are your thoughts about the way he delivers this sort of information? Do you think that this is standard, normal? Should we expect something more from him?
There are two issues here. I mean, the first issue is that what I already said, that we've got a lot of unknowns. So it's not the story of the inflation being really under full control. This is the story about the inflation that looks quite okay, but some factors may easily push it once again. If they do not appear, then it may stay or even fall. But in any case, there are some unknowns here, and that's why it's quite reasonable that the central bank cannot make a clear commitment. But the second point is maybe more interesting. President Glapiński had a kind of a devastating history of his behavior, his communication before the last parliamentary elections, when he was clearly he was assessed to try to play a political role and to support one party against another with the decisions. And now it seems that he tries to rebuild in a sense the confidence of the central bank and its political independence. And if you remember, 2 years ago exactly, he was making the comments about even the comments to bypassers on the mole on the Baltic Sea about the rate cuts that will happen. So that was obviously dramatically wrong. but once again, it was like big support for the party that was ruling at that time, Poland. So I guess after this lesson, Professor Glapiński tries to be much more cautious in what he's telling and what he's talking and trying to rebuild.
So he's just playing it safe, essentially.
Yeah. The problem is that you may lose part of the confidence overnight, while rebuilding the confidence, the market confidence takes many months or quarters. The banks, as you notice, were not happy because they have been projecting the cuts since many months. Frankly speaking, I was not so surprised that there was no. And then today they say that they were surprised because these rates should have been made a few months ago. Okay, in any case, that although indicates whoever is right or wrong, it's not a point even at this moment. It already indicates that the communication between the bank and the central bank and even the commercial banks is in the market is not perfect. If the commercial banks are openly claiming how much they have been surprised by this cut.
Okay, I want to move on to Romania, just so that we can fit in both topics. Romania is in for a bit of a roller coaster with some really drastic fiscal measures in order for that country to actually get itself in order economically. It looks like they're in for a bit of a situation where if there is no extreme pain, there is no gain. Is this the fastest way to get Romania to be a level EU player? Is this the right formula for the near future, mid to long term? What are your thoughts on what lies ahead for them?
Well, if you look at the economic performance of Romania over the last couple of years, and on the one hand, Romania had quite a nice growth record. I mean, they surpassed Hungary with GDP per capita, approached the Polish level of GDP per capita. So on the one hand, there was kind of a success story. But it was accompanied by a very, very big instability in the economy, very high deficits, fast-growing debt, and not only the budget deficit, the public sector, but also accompanying very high current account deficit. Sometimes it may be even more dangerous because frankly speaking, I do not expect the Romanian government to go bankrupt even if they continue with relatively high deficits. But the weakening of the currency because of high current account deficits and cutting the rating and so on, all of those were and are still credible possible risks for Romania. So I guess there's one more factor probably here two factors. The first one is that the new government, it's the same big coalition, but somehow probably was boosted to a degree by the winning of the liberal candidate for the presidency. So it's makes the story. They make them stronger. On the other hand, it was just announced that Bulgaria, the local, let's say, rival for Romania, will be introducing the euro from the next year. So in a sense, Romania and Bulgaria is poorer, but much more the economy is kept in equilibrium. So probably it also had some impact on the decisions of the government. Romania did have at some moment to stop this process because it was on the path of the very fast growth of the debt, and even if this threat of insolvency is a bit exaggerated. If a politician wants to convince the population that cuts are necessary, then he must use this type of words. Saying that Romania might be downgraded and maybe bankrupt and so on. Frankly speaking, directly this type of the risk was very far away, but still it was clear that Romania is on the very dangerous path with both deficits of the government and the current account, so it means in relations with the rest of the world being much too high, probably the highest in the European Union, both deficits the highest in the European Union. So the most the country the most in disequilibrium in all the European Union, and the growth okay, but the growth accompanied by very, very, very high.
Well, I want to ask you about growth because how deep do you think that the Romanian government can cut without derailing economic growth? We see 1.4% in 2025. This means that they are borrowing a lot, but it doesn't translate into economic growth.
No, I guess there is the issue that if you continue a relatively good economic performance, but at the expense of increasing dramatically the spending, the deficit, so on, then at some moment you pay the price for that, and you will have to, and Romania will have to pay the price. So this splendid macroeconomic growth performance will most likely be stopped. We don't know. Okay, I mean that's the proposal of the government. Even without this proposal, the International Monetary Fund projecting a major slowdown in the growth in Romania. And now with that, it may even bring if the program is really fully implemented, we'll see obviously, that may bring the GDP of Romania, to halt, to stop growing at all for a year or so. So this is sometimes a price you pay for allowing for the too big increase of the debt, too big increase of the disequilibrium. Inflation is although obviously higher than all the other EU countries. So altogether, this economy must slow down because otherwise it's not possible to stabilize it.
I just wanted to ask a slightly more political question. The new Prime Minister, Ilie Bolojan, has a track record of efficient change implementation, but also is experiencing significant opposition, and it's already being voiced in the government. He's delivering, or wants to deliver, a long-term plan that will be executed in 3 stages. What are the chances that government backlash might get in the way? Because we already see public discontent seeping through.
Well, we'll see, because it will remain to be seen, because the coalition is pretty fragmented in Romania. It's a great coalition of parties that were normally had been competing with themselves. I mean, they have been forced to form a coalition under a risk of the far-right party blocking everything. So altogether, it's very difficult to make this. I guess what the Romanian government is trying to do is kind of what we call sometimes and trying to escape by speeding up and moving further forwards, because realization of such a program is something that may, although to a degree at some moment, consolidate the very fragmented coalition. The point is, what will be the size of the discontent of the society? Please remember that the crucial coalition partner of the Liberal Prime Minister is the Social Democratic Party, that was normally in favor of pretty much increasing the spending on the public sector and having the support there. So for them, it will be a problem. And we will see either this coalition will be able to implement this program and to survive or not. As far as they are presenting it as the only way for Romania to avoid a catastrophe, that is an exaggeration, frankly speaking. The imminent catastrophe was not near aside, but sometimes, politically, you must put the story this way to get society to make the society understand the necessity, and the coalition partners. But we'll see. It will be a big test for the government, and especially for this second, actually the biggest party in the parliament, the Social Democratic Party, that is now member of the coalition but without the prime minister. And we will see, will they be able to withstand this temptation to stop their support for the government. We'll see. That depends partly although on the effect, how painful the effects will be.
Of course. Thank you very much for your insight, Professor Witold Orłowski, economist and lecturer from Warsaw's Vistula University. As always, thank you very much for your insight.
Thank you.
And that concludes The Bottom Line for today. I was your host, Marie Cato. We bring you the best of regional business Monday to Friday at 5:10 CET on TVP World. And in the meantime, for the latest in regional business, follow us on X and on tvpworld.com. Bye.